Hey everyone, and welcome to This Explainer. I am absolutely thrilled to have you here today, mainly because we're tackling a topic that literally makes or breaks new businesses. We're going to unpack the incredibly insightful strategies laid out by Imtiaz Hassem on navigating the really high-stakes world of startup funding. Now, if you've ever thought about securing capital, you probably already know the basics, right? But today, we're going a lot deeper. We're looking at the comprehensive strategy. We're talking the psychology, the hidden risks, and the exact steps you need to take before, during, and, well, after that check finally clears. We're going to meticulously break down Hassem's framework, explaining everything in detail, so you have a totally clear, structured roadmap to funding success. To keep us on track, here's our chronological agenda. First up, beyond the capital. Second, mindset and brand value. Third, the strategic funding ask. And finally, managing funds and risk.
Okay, let's dive into this. Part 1. Beyond the capital, vetting your investor.
See, when you raise funds, you aren't just getting a passive deposit dropped into your bank account. You're actually bringing a living, breathing person into your carefully built business ecosystem. To really grasp what that means, you have to look at the total package an investor delivers. First is identity. You must intimately know who they are, and just as importantly, they need to clearly understand who you are. Next is network access. Can their partnerships and industry connections fast-track your growth? You've absolutely got to utilize those. Then there's their specialized expertise. That's what gives you an unfair advantage in your market. And finally, the ultimate tiebreaker, their mindset and intentions. Moving right along to part 2, mindset and brand value, or the hidden costs of capital. You could have an investor with insanely deep pockets, a massive Rolodex, and decades of expertise. But if their mindset is flawed, the whole partnership is pretty much doomed. Just consider the stark contrast between two types of investors here. On one hand, you've got aligned values, an investor who genuinely shares your expectations and philosophy, like, say, a real commitment to fairness toward customers. But on the other hand, you have a purely profit-driven approach. Hassem warns us that if an investor is strictly driven by extracting profit at the expense of your core values, that mismatch isn't just a minor speed bump. It's actually a structural flaw that will create massive problems and serious long-term conflicts down the line. And beyond internal conflict, there's external perception to think about. An investment directly impacts your company's value and brand perception in the public eye. So associating with a reputable investor, maybe a respected director of a well-known company, acts as this massive boost to your trustworthiness and your perceived legitimacy. But on the flip side, partnering with individuals or companies that have a damaged reputation or worse, legal issues, that will severely harm your business. And the real kicker here, that damage happens regardless of how much capital they actually bring to the table. Basically, bad money taints a good brand. All right, part 3, the strategic funding ask, navigating the negotiation. So you've vetted the investor, you've ensured their brand aligns with yours. Now we shift from the philosophy of investment to the actual practical psychology of asking for the money. When you sit down to finally ask for funding, let's be real. Investors rarely just write a check for your exact verbal request on the very first try. It's a negotiation. So here's the logic. Step 1, ask for a slightly higher amount than your bare minimum requirement. Step 2, this builds a necessary buffer, leaving room for the investor to negotiate that number down, which, by the way, they want to do so they feel like they've won a concession. And step 3, because of that buffer you built in, even after their reduction, you land on the exact amount you originally required. It's like a highly structured, logical dance. So the crucial point is this. While that buffer strategy is incredibly smart, it has to be executed with absolute, uncompromising care. Do not ever create the impression that you're just inflating numbers merely to secure funding. Because if an investor even senses manipulation or feels that your numbers aren't completely grounded in reality, trust is instantly lost. And in the high-stakes game of startup funding, losing trust doesn't just kill the current deal, it permanently destroys your reputation in the broader investment community. Finally, part 4, managing funds and risk, the post-investment strategy. Let's assume you've navigated that negotiation successfully and the check actually clears. You might be sitting there thinking, the hard part is over. Well, welcome to startup life. It has literally only just begun. And this brilliantly illustrates Hassem's conservative risk management approach, which centers on a strict 50-50 split. When you receive that investment money, you use only 50% of those funds initially for your business operations. The remaining 50%, that becomes protected capital. By doing this, you are implementing massive risk mitigation right out of the gate, making absolutely sure you don't burn through your entire runway on just a single unproven hypothesis. Now, why hold it back? What exactly happens to that protected 50%? We're not skipping any options here. First, if your primary business idea fails, and let's be totally honest with ourselves, that is a very real possibility in the startup world, that half of the capital remains perfectly protected, rather than being completely lost to a sunk cost fallacy. Second, having that cash gives you the agility to pivot. You can use those remaining funds to start a new, more viable business idea based on everything you've just learned. Or third, you have the option to gradually return that remaining money to your investors. And I want to emphasize that third option. Returning the funds signals profound responsibility. Think about it from the investor's perspective for a second. If the primary venture completely fails, seeing a founder who actually protected capital and is committed to repayment, that is incredibly rare. Maintaining that trust isn't just about being polite, it fundamentally increases the likelihood that this investor will support your future endeavors, effectively cementing your long-term credibility in the market. Wow. Okay, we've covered a lot today. Everything from vetting the mindset behind the capital, to the psychology of the ask, right down to the disciplined 50% rule of post-investment survival. It really is a comprehensive ecosystem of decisions. So I want to leave you with this final, critical thought to ponder. Based on everything we've explored today, are you truly ready to manage the complex partnership and the heavy risk that comes with investment? Or are you just looking for the money?